Well, hello, everyone, and thank you so much for joining us today. We've got a really interesting webinar on how you can obtain passive income through U.S. mortgage note investing. This webinar is really focused on investors that are in the United Kingdom, but we work with other investors. It's not only for the United Kingdom. So a lot of what I talk about here will also be relevant if, for example, you're from another country. So just keep that in mind. So let's go ahead and start. I did get a chance. I need to first go through a disclaimer. It is so important to put this in there. So I want to say this, and then after that, I'll go through the presentation. So as accredited investors, you will be aware that all investments carry some level of risk. This investment is only available to investors who are able to assess their own appetite for risk. So please read the risk statement within the investment memorandum before investing. Okay, well, fantastic. I got that taken care of. Now we can get to the fun part where we talk about how you can get some passive income. All right, so the overview, I'm going to point out a few things. We offer a passive income bond, and our mission is that we purchase real estate-backed mortgage notes in the United States, and then we pay out passive income to our bondholders. We provide investors and also institutional partners, whether that be private, whether that be, for example, hedge fund, whatever it might be, we provide passive income, and we oversee all of the notes. So we take care of all of the work and you get all of the passive income. Most of our investors prefer it that way. So the instrument is a fixed income loan note. We suggest a minimum investment of £100,000, but that doesn't mean if somebody wants to do a different amount that we can't work with them. We will work with smaller amounts, but we suggest £100,000, and you can earn an 8% rate of return. We'll go through the team. Our team has 200 years of experience with 100 years of experience in the mortgage note industry. We also offer 100% money back guarantee on any non-performing notes. So if we end up with some non-performing notes in the portfolio, those are removed. That's something that's so important. So let's go through the team here. I want to briefly introduce the team that will be working with you so you know who's working for you. First of all, let me introduce myself. I am an experienced businessman. I've been involved in business a lot of years. I also am from the United States. I'm an American. I trained with the largest private note buyer in the United States. His name is Eddie Speed, and Eddie has actually purchased over 50,000 mortgage notes over his career. So by now it's probably over 100,000. Our team members have worked at a lot of different companies. Some have managed investment funds, real estate projects worldwide, and overseen up to $1 billion in financial assets. So we've got a very experienced team that you can check out. I've done real estate and mortgage note investing many years. Marina, she is our international investment coordinator. She graduated from the EU Business School, and she actually speaks 5 languages. So if you have a particular language that you like to communicate in, there's a good chance that Marina can speak with you and help you get set up. Scott Wynn, he is our industry expert. He's a veteran of the mortgage note industry. He has been doing mortgage note investing for 30 plus years. He has been active in buying owner-financed real estate notes. He's also a specialist in what are called junk assets. And what that means is he has a great deal of experience with taking an asset that is not performing, like a mortgage note where the borrower has stopped making payments. He's very good at getting the borrower to start making payments again, or through, for example, perhaps a loan modification, or if it needs to be a deed in lieu of foreclosure or even a foreclosure. He has a lot of experience with that sort of thing. So he adds so much value to the team, and he's a great guy. Fred Hobbs, he's our director of mortgage servicing. Fred owns a company in Texas called SecureNet Loan Servicing. They are servicing around 2,000 mortgage notes. He's also a licensed mortgage loan originator, and he has originated thousands of private money residential notes. And when he puts together a package on a residential mortgage note, it's always in great order. I mean, so well done. David Jones, he's our in-house legal counsel. David is licensed in the state of Texas as an attorney, and he helps us at Alamo with, for example, everything that we need to do on the notes to make sure that we've got a good, valid note that we're buying so that we can pay passive income reliably to our investors. Anna Kulikova, she is a specialist with investor relations. She works with investors to try to help them reach their passive income goals. She's wonderful. Mark DeRuyter is our chief technical officer, and I want to explain. Mark's pretty unique. He has many years experience in computer programming, but more than that, within the niche of computer programming called financial services. So he has actually written mortgage software for a lot of companies. He really brings a lot to us in terms of keeping track of all of the information, a place for everything and everything in its place. But more than that, also systems, and he's a great architect and a great programmer. Okay, so let's get to it. With this, you can get 8%. We have designed this financial product where you can get 8%. And that is something that we offer several options. We offer a 3-year, a 5-year, and a 50-year. So if you were to purchase a 3-year bond, you're going to get 8% for the next 3 years, payable biannually. On a 50-year bond, if you were to purchase one of those, that's more of a product that usually appeals to institutional type investors, where it gives them an advantage on calculation of duration in their portfolio. But it's something that also is available to individuals. Maybe you're in a situation where you want to ensure a long-term income stream, and this 50-year bond allows that. So now let's look at something, and I really want you to notice in this graphic a couple of things that are here. Look at this. I'm going to show a short video.
Today I want to talk about something that is very interesting, and this is if you are an investor that's an accredited investor in the United Kingdom. You may be wondering what is going on with the 30-year Treasury gilt yield. So let's take a look at this and talk about it for just a minute, and then we'll compare it to Alamo Mortgage Holdings, our yield. And I'll give you a hint. Alamo Mortgage Holdings has a far, far higher yield. So if we were to go back to, say, the year 1980, the highest that we have here is around 1981. The yields were running about 13, almost 14, 13 and a half, 14%. And then you notice how over time, the general trend has been largely downward. I mean, we look here and we see that the yield as of, for example, 2016, if we look at 2016, the yield's like 1.4%. And then if we go all the way down to May of 2020, the yield fell all the way down to 0.57%. Now it's starting to slowly go back up. And as of this video, December 2022, the yield was at 3.678%. So let's just kind of compare that. Let's imagine that you buy gilt. You would get a 3.68% yield if you were to purchase a 30-year gilt. But now imagine that you instead decided to purchase an Alamo Mortgage Holdings bond. How much would you make? Well, that is a great question. I'm happy to answer it. So basically, with an Alamo Mortgage Holdings bond, you'd be getting right here at 8%. That's a tremendous improvement over what you can get on a gilt. Now, I know a lot of people are going to say, but a gilt has a zero default risk. I get it. I understand. But here's the thing, folks. You're getting such a low return on a gilt that you may want to consider if that actually makes sense to you in terms of what you're dealing with there. Because if you were to instead purchase an Alamo Mortgage Holdings corporate income bond, which is the bond of a UK company, you'd be earning right at 8% yield. And if we were to go back in time, you wouldn't have seen a yield like that for many years. You would have seen the last time gilts were giving an 8% yield was looks like it was right around let's see, when was it? 1996. So almost 30 years. So in the last 30 years, it hasn't gotten close to an 8% yield. So that's worth thinking about. If you would prefer to get an 8% yield, and you understand that it's not a government-backed guarantee. It is backed by collateral, though. It's backed by mortgages. It's something that you definitely should consider. Be happy to chat with you about what Alamo Mortgage Holdings can do for you in terms of providing passive income. And I wish you a fantastic day.
Fantastic. Well, very good. So now that we've looked at that, I want to go on to the next slide. And this is specifically for someone that's in the UK. Maybe they're thinking, you know what, I'm in the UK. I know how a gilt works. I know how that works. I'm going to just buy a gilt because they're rock solid, safe, passive income. They're guaranteed by the government. You know, maybe I'm not going to get as much as Alamo, but, you know, I'm just going to stick with a gilt. I want you to watch this, please, and think about this. Now, let me go through this here. If you're looking to purchase gilts, let's say you're looking around and you bumped into this video and you're looking to purchase gilts, you probably are in the situation where you want a reliable way to obtain passive income, and gilts would fit this requirement. The problem with gilts, though, is they are denominated in British pounds, and the pound has a decades-long history, a tradition of losing value against the US dollar. Another problem with purchasing gilts is that the returns they offer are lower than corporate income bonds. They're always lower. Interest on all registered gilts is payable gross without deduction of tax. Holders of gilts on the register maintained by CIS may opt to have tax deducted at source by applying to CIS. Gilts, of course, have their merits. And for an investor, this is important. Gilts have their merits. And for an investor that can turn a blind eye to the high rates of inflation. So if you're the type of investor that can see all that high inflation in the United Kingdom and you can just shut your eyes, turn a blind eye and say, I don't see it. That is one of the requirements. The second requirement is if you can also, with your other eye, turn a blind eye.
I told him I'm not going to be on video, so
you can just
let me ramble on.
That for decades your pound has lost value against the dollar. Ever since Bretton Woods, it's lost and weakened against the US dollar. Then if you're that type of investor, then yeah, you can accept gilts and you'll get paid on time and you'll get some passive income and it'll be great. And they're index linked and you can go to sleep and just you turned a blind eye on both of the problems and hey, everything's good. Yet the fact that gilts are easier to purchase and more well-known does not mean you will earn as much interest. If you were to instead purchase my company, Alamo Mortgage Holdings, we offer a corporate income bond. If you were to purchase a corporate income bond through Alamo Mortgage Holdings, you could potentially earn hundreds of basis points more per year on your corporate income bonds than those old gilts. If you're interested in purchasing a bond, you can contact me directly by emailing ben.miller@alamomortgageholdings.co.uk or call me. I've got a US number, 1 for the United States, and then area code 817-203-4160. We can have a discussion about your passive income goals and also your investment goals. If after that discussion, the product seems suitable for your investment portfolio, you then can sign some paperwork that will be prepared based on the term of the bond you are looking for and some other features. If you currently have British pounds and you want to exchange for US dollars, that's easy to do. We simply handle the conversion for you, and then your bond is paid in dollars. At the point it is converted, you have made a dollar-denominated investment and no longer will potentially lose money on the exchange rate if the US dollar keeps rising against the British pound sterling. If you are in the situation where you have pounds and normally would want to purchase gilts, but you're looking at all this inflation and the pound endless. So that is so relevant, because a lot of people, they look at this and they're not thinking about how it actually impacts them, the exchange rate. They know about it, they're smart people, but they're just not really thinking about it when they get so used to hearing, oh, I'm going to buy a gilt, I'm going to buy this, I'm getting this amount in pounds. Now, I want to go through a couple things here. Basically, we purchase mortgage notes, and as an example, let's say we find a mortgage note that costs $100,000. Let's imagine that this mortgage note in the United States, in Texas, say it pays 10% interest. And we'll talk about why the interest rate would be so high. I know that none of you have those sorts of mortgages, but I'm going to explain why that happens. And then with that, there'd be, we might come in and we would purchase for $70,000. Now, we're not buying from a normal situation. We're buying from a motivated seller. Just like in real estate, you have motivated sellers. Well, in mortgage notes, you have motivated sellers. So that's how we can get that type of a discount. And basically, after the purchase, we give the seller $70,000. And then at that point, the borrower still is making payments because we're the new lender. We've traded positions. So if we purchase that 10% note at a discount where we buy it at 70 cents on the dollar at 70%, the yield on this hypothetical note is 14.2%. Well, if we're getting a 14.2% yield, it's not hard for us to pay our passive income bondholders an 8% yield. So that is how it works. Now I'm gonna talk about, well, that's great, but how do you actually determine what these things are worth? How do you determine the value of a note? And I'd like to share this with you where you can gain a little bit of an understanding on how you might price a mortgage note. So then what determines the value of mortgage debt? Because we know what determines the value of real estate. Real estate is determined by the value of a particular flat or house. It's determined by what are comparable houses and flats. What do they sell for? That determines the value. If it's a commercial property, it's determined differently, where it's determined by the cash flow on the commercial property. But for this example, if we talk about a mortgage note on, say, a property of maybe a residential home, there's 6 factors that determine the value of a mortgage note. The first factor is the buyer. So if you had a choice between buyers, say you have a property and you're trying to decide who to sell the property to, and you've got one person that is a government employee, and that government employee has a high salary. They've been working for many years for the government. Maybe they work as a post office person. Maybe they deliver packages for the post office. And they've been doing this for 10 years. If the government is their employer, there's a very high probability they're going to get paid on time. But if you have another buyer that says, I'm 24 years old and I just started my new company and I'm just going to make a bunch of money with my company, and they don't have a regular income, but they have a plan where they're going to make money in the future, that sort of buyer is far less desirable. It's better to sell the asset to one that has a regular government income, the government employee, or the one that works at some sort of a big corporation. Maybe they work at Microsoft, maybe they work at Google, maybe they work at some big corporation. That buyer is more likely to be able to pay, where they are not going to have cash flow experiences where the things are up or down. The second thing that determines the value is the collateral. So the collateral means the actual asset. So let's say that the property is worth 100,000. Say that's the market value. That's the real value, 100,000. But say that you had a seller that he sold the property with a note for 200,000. Pretend he found somebody who didn't know the prices, and that person agreed to pay 200,000, even though the market value is only 100,000. You have to treat that note differently, because the fact that he found somebody that signed a note and the asset's only worth 100, but he found someone that signed a note for 200 does not make the note worth 200. You could look at that note and you could base it on the value of the collateral. So that's a mistake, is a lot of times people don't look at the collateral, they just look at the value of the debt. And when they see the value of the debt, they may not have properly analyzed what's the collateral worth. The third factor that drives the value is the down payment, the money that the buyer initially paid. So let's say you had two buyers, one that put 30%, 40% of the purchase price, where if it was 100,000, maybe that buyer put down 30,000, 40,000, 30 or 40%. And then say another buyer said, you know what, I want to buy this. I'll pay you the 100,000, but I only have $1,000. I only can put down 1,000. Can you finance 99,000? And the seller agreed. So they both agreed to buy the asset for 100,000, but one of them put down 20,000. Another put down only 1,000. The one that put down the larger down payment is better, because there's less risk of the person saying, you know what, I don't want this. I'm just going to leave. I'm just going to move. I'm just going to, do, because he's got virtually nothing to lose. He lost $1,000, his down payment. But the one that put 20,000 or 30,000 down, he lost a lot more if he walks away from the deal. So that's why you look at the buyer's equity or their down payment or their upfront money. That's an indication of the value. So a buyer that puts down 10% is better than a buyer that puts down 1%. The fourth thing that's important is the actual interest rate. The interest rate on the note. So if you have a note, if you have a mortgage debt that pays 10% or 12%, that is better than a mortgage note that only pays 5% or 4%. So if you had a choice between two notes, two mortgage debts, and the first paid 5% and the second paid 10%, the one that paid 10% is better. The next factor that drives value is the history of the payments. So when you buy these mortgage debts, you want to look at how long has the person been making payments. You want to be careful buying a new note. You want to see a record of how long the person has been making payments. So if a person has a 30-year note, and they are 4 years into a 30-year note, where they still have 26 years left. That is safer if you see a record of payments compared to a 30-year note that the person put the down payment down, but they haven't yet made their first payment. Because what if the person just walks away? What if they don't make that payment? Then you've bought a note that is a non-performing note. You want to buy a performing note. A performing note is more valuable than a non-performing note, because then you don't have any work to do. You just buy the note, and the borrower makes payments to you. So a performing note is better, and the history of performance is important. The next factor that drives value, the sixth factor, is the actual paperwork, the legal paperwork, if it was done properly. Because if you have a note that was just two guys that were sitting around a kitchen table and they worked out a deal and they wrote it up without a lawyer, where they just wrote up an agreement and they signed it, that is less valuable because the note likely has mistakes. They're not lawyers. They just agreed that, yeah, I'll make payments to you for 30 years. Did they remember to put in any of the legal language? Did they know how to put any of the legal language in? These things are important. That type of note is less valuable than a note that had a proper closing at a legitimate company with legitimate lawyers that drafted the paperwork. Because you know that it's very likely that if you buy that note and the borrower doesn't make payments to you, you have legal recourse. You don't want to buy a note that hasn't been drafted properly, that doesn't have proper legal paperwork. So very important there.
All right, excellent. So those are the factors that really determine a note's value.
So then,
and now let's take an example. This will clarify it even more. This is not an asset that's in our portfolio. It's an example, but it is a real property. So this is a property in Texas that is being sold. It's actually being sold now. The sales price on it is $120,000. And now let's imagine that a buyer came forward to the seller and said, I want to buy that property. And the seller said, okay, pay me $120,000. And the buyer said, I don't have $120,000, but I can pay you $20,000 down. And the seller at first said, no, go to the bank, go get a bank loan. There's a good banker I know, he'll make you a mortgage, and then you can just pay me all $120,000. So the buyer went over to the banker and said, can I please have a mortgage? I've got a $20,000 down payment. And they said, well, you don't have a high credit score. They said, you don't have reliable income. You're self-employed. No, we won't give you a mortgage. So then the buyer went back to the seller and said, I tried. The bank said no mortgage, but I really want this house. I'll pay you. I'll make the payments to you. I'll put $20,000 down and I'll pay you every month. And the seller's in a situation where the house is hypothetically, let's say it's paid off where there's no mortgage on it, and the seller has enough money where they really don't need the money for that sale that much. So they say, well, I might do that, but I'm not going to loan it to you at a bank rate of interest. I'll make you a loan at a 10% rate. And the buyer said, hey, that's good. I'll be happy to pay you 10%. I'll get my mortgage once I get along further. So they sign a note. It's a 10% interest rate, and the debt is $100,000. The seller receives $20,000 from the buyer, and the buyer now is responsible for making monthly payments of $877.57. Now let's fast forward 5 years. Imagine 5 years have passed. And during that 5-year period, this buyer has done a great job. Every month he set it up on automatic payment, and every month he pays $877.57 to the seller. He's made 60 payments, but the debt on that, even though he's paid a lot of money, the debt on it, of course, due to an amortization schedule that we all know how that works,
there's still a large unpaid balance because in the beginning, most of the payments are going to interest, not principal. So the unpaid principal balance of the note is $96,574.32. Now let's imagine that seller wakes up one day and decides that he needs cash for whatever reason. He needs cash. He asks the buyer, "Can you please pay this off?" And the buyer says, "I still can't get a loan." And then the buyer looks around, the seller looks around, and he contacts a company like Alamo Mortgage Holdings. Alamo Mortgage Holdings comes in, and we say, "Well, you know, the most that we would be willing to pay for that note is $83,322. This is hypothetically. We might try to buy it for even less than that. We might try to buy it for $70,000. But in this example, let's say we agreed to buy it for $83,322. The investment to value, the equity, in the note buyer equity is $36,677.61. If the buyer doesn't pay, it's fine. The property's worth a lot more, and then it can be taken in foreclosure. So you're almost hoping that buyer doesn't make payments. Now, I'm joking. I'm not actually wanting that on anyone. We're not trying to get people's houses. We're just trying to make a profit on the paper side of the business. But if that buyer stopped making payments, we would be in a position where we could take the asset through a legal process and then resell the asset, and we would come out ahead. So the present value is there. That's basically how it works. Now I want to show something that for our friends in the UK is so important. I really want you to look at this graphic. It is just so important. After Bretton Woods, the agreement from towards the end of World War II, the Bretton Woods agreement, the British pound, one British pound purchased $4.03 US. So if you had pounds, you could get $4. Now look at what happened over time to the British pound. If you went to say 1967, the British pound had fallen from $4 to only $2.40. And if you went to say 2007, it had fallen further to only $2.05. And if you went to as recently as the 1st of January in 2023, one British pound only buys $1.21 US. What in the world's going on there? And how does that affect your investments if your portfolio is in British pounds? And a lot of you in the UK, the vast majority, some have even all of their portfolio in British pounds. This is something you should think about, because you can make great investments, but if that British pound is losing a lot of value, that has an impact on it when you try to use that money. Imagine you go traveling, you travel abroad. You may remember years ago when you would travel abroad, maybe you went to the United States, how much more buying power your pounds had. Well, this is relevant, and it's something that a lot of times is overlooked by investors. They turn a blind eye. They just pretend it's not happening, or they just don't really have a solution because they're like, well, I'm in the UK. I invest in pounds. I'm not a currency trader. I don't mess around with that stuff. This is not currency trading. You're buying an investment that is a passive income investment. We do an exchange for you if you want, and you don't have to do the exchange if you want to stay in pounds. Some people are bulls where they're a pound bull and they think that it's going to go higher. That's fine. We will sell you the investment in pounds and we'll pay you in pounds. Or if you want to diversify your risk, we'll sell you the investment in pounds, convert it to dollars. So now you've got a dollar denominated investment. We'll pay you in dollars, or we'll do half and half if you're not sure which way. Either way is fine. So that's important. I want you to think about that. Now I'm going to show just an example of a real package of mortgage notes. So this is a real package of mortgage notes. And this will kind of give you an idea of how it works, but you're going to get 8% with Alamo. So Alamo does all the work, but here's an example of a type of package of mortgage notes.
So this right here is actually an example of what a portfolio of loan notes might look like. So this is actually a real portfolio. And you look here and you can see the name of the borrower, the number of months. You can see the interest rate. This debt is actually pretty high, 14.75% is what they're paying on that mortgage. The monthly payment is $278.50. Then you can see the terms, the status, this sort of thing. So, I mean, you've got a list here, and this is an example of a package where a package of these mortgages can be purchased. This type of deal would be done by a larger investor. It would not typically be a single investor that would buy this package. For example, my company, Alamo Mortgage Holdings, this is the type of package that we might actually purchase, something like this. But if you're just starting out in investing, you might start out by you're just going to buy one mortgage note. So for example, you might come in and this mortgage note, if you find something like this out on the market, you might try to negotiate down from, the unpaid balance at $89,570. Maybe you try to buy it for $59,000 or $69,000. But that would be one note. But you can also purchase packages of notes. And that's something that Alamo Mortgage Holdings is involved with. It's a company that's a United Kingdom company that actually purchases packages of mortgage notes. So wanted to give you an idea of what a package of notes look like.
Okay, very good. So that's just an example.
So
now we also do commercial notes. Since we're kind of short on time, I'm going to skip that, but we don't just buy residential. We also buy commercial notes. Let's talk about bonds. And this is something that I think is so important for investors, because over the years, I get asked a lot of times by people to look at their portfolios to give my thoughts on how they're doing things. And one thing that I like to do, so I'm not going to give you my personal opinion here. I'm going to talk about a Nobel Prize winning economist. And his name is Harry Markowitz. He won the 1990 Nobel Prize for Economics. And he was one of the contributors to what's known as modern portfolio theory. This is something that's used all over the world. It's taught in all the business schools, modern portfolio theory. Well, now we're going to talk about what he did with his own portfolio. So this is very interesting to see what Harry Markowitz did with his own portfolio, the Nobel Prize winning economist. He had a pretty simple system. He would split 50% of his portfolio into bonds and 50% of his portfolio into stocks. So the reason he did that was he basically was saying that with this simple approach, he thought about what would happen if I was in the stock market and I had or if I was not in the stock market and I had all my money in bonds and the stock market went way up, I'd miss out on all that. That'd be frustrating. So his grief. And if it went the other way, imagine that, a Black Monday happens where there's a massive drop in the stock prices and he was 100% in the stocks, a black swan event. Boy, that'd be a disaster. He could have a major loss in his portfolio. So he just split half in bonds, half in stocks, and then he'd adjust it once a year. Now, folks, I'm not telling you that you should do that. I am asking you to think about your own portfolio and figure out what percentage of your portfolio is in bonds. Just think about that. Think about if it makes sense if you're happy with the way that you've got it structured. So that's something that's important, and there's a lot of reasons for it. So I just show that. Now I want to, we're almost finished here. Why Texas? I mean, why are we not buying mortgage notes in New York? Oh, that's a great question. The reason is that Texas is a state that is growing. Texas is a state that a lot of people from New York and from California, they're moving into Texas. And that makes the real estate go higher in value as more people come in, they buy real estate. So Texas is an ideal state. Another advantage to Texas is that it is a state that's much easier for a lender in terms of the law. So New York is a lot harder. The foreclosures there can take a long time, but Texas is very simple, very simple. So let's talk about the advantages and the key features. The first advantage is you can reach your passive income goals. And there's no passive income goal, no matter how high it is, that we can't help you get to. So for example, if you're looking to get to 5,000 pounds, 10,000 pounds, even 100,000 pounds a month or more, we can help you get to that passive income goal. And we can actually do it in as short as 30 to 60 days, depending on how much capital you have to place. We also offer maximum diversification. So that is what's great about Alamo, is you're not investing in an individual mortgage note where you have to hassle with any of that. We do all that work for you. You're investing into a portfolio of mortgage notes. The other thing, this is kind of old fashioned, but we don't charge our investors any fees. Now, I know in the world of hedge funds and 2 and 20, that sounds like a strange idea, not charging fees, but we have a simple business. Our business is we sell bonds at 8%, and then we buy mortgage notes at a higher yield. And that's it. So we think that we should make our money on the work that we do instead of just stuffing in a bunch of fees. Now, I'm not giving those guys that have hedge funds a hard time or private equity guys a hard time. I'm not saying they don't deserve their fees. I'm just saying that if you invest with Alamo, you're not paying any fees. We're using the money to buy notes, and we're not charging our investors any fees. And another thing is we also offer interest payment flexibility. You know, we give you the choice on that. So it's one of those things where, you know, we can work with you in terms of what you need. Here's an illustration. You place 100,000 for say for 1 year, you get 108,000 pounds. If you were to place it for 5 years, you'd get 140,000 pounds back, 40,000 pounds in interest, 100,000 pounds in principal. Or if you were to do the 50-year option, and that's an option that makes sense from time to time if you're trying to ensure a long-term income stream, with that you get 500,000 paid to you, and it's paid where you get 400,000 over the 50 years, and then you get 100,000 when the bond is paid off. So why should you invest in the note? Well, the director believes, that's me, that an investment in notes is suited to investors that are seeking an above average return on investment. If you just want to be an average investor, go buy a gilt. You don't need this. You can just go buy a gilt if you're content with being average. But if you want a greater return, if you want more interest, if you want more money, this is a product that you should consider. You also should invest in this if you prefer security-based assets. So, you know, a lot of the people, they make unsecured loans, and those pay really high rates. You know, credit card debt, for example. If you like that, if you're comfortable with unsecured, then you could do that. But this is something where if you want the security of a note that is asset-based, our notes are asset-based. Passive income. If you're looking for passive income, Alamo Mortgage Holdings has a solution for you. So you can choose a term of 3, 5, or 50 years. Sometimes we get asked, can you put the notes into your self-invested personal pensions? Well, that is a question that's technically it's subject to the approval by your sipp provider. But if you ask your sipp provider and they're not helpful and they're not able to help you, ask us, because we know a lot of other sipp providers, and we can try to get you one that's more helpful if they don't want to let you do that. What type of investment is it? This is a corporate income bond. You're not buying a UK government bond. It's a corporate income bond. Is it a regulated product? No, it's not a regulated product. And that actually is part of the reason that we can pay more. We have not had to go through a full registration process and spend a lot of money on that. And instead, that money that could have been spent on registration, it's available where we can pay out higher returns to our investors. So who can invest? Well, You've got to be at least 18. And thankfully, I feel like everybody in this meeting is going to be at least 18. So we've got that taken care of. You could be a trust, you could be a company. We'll even take investments from charities, and we invest and the charity earns money. How's your money protected? Well, we offer multiple layers of security and safeguards to protect capital, and we can discuss that in a one-on-one call. Can you invest through a company and are joint applications permitted? Yes, we say yes. Alamo Mortgage Holdings says yes. We love our investors and we want to give them as many options as possible. How's a loan note different than a government loan note? Well, the loan notes are a little bit different there, and we can talk about that one-on-one if you have any questions. So how's the tax managed? We pay all the money to you. We don't take money out for taxes. We send all of the money in interest to you. We pay you gross, and then after that you can decide with your tax professional what you want to do based on your marginal tax rates and your particular requirements. But we don't try to keep track of these deductions. We just pay 100% of the money to you. Are there any limits on how much you can invest? No, we have no upper limit, and institutional investors with larger capital amounts, they are welcome to apply. We welcome that. We suggest 100,000 pounds, but that doesn't mean if you're just getting started with us and maybe it's your first year, we can get you on an annual investment program where every year you're investing to build towards your passive income goals, to build a bond ladder. We can work with you on that. Can you get access to the money early? Great question. The answer is no. You must be certain that you will not require your money until the term expires. It's not possible to access your capital before the end of the investment term. We plan it so that we can, when we need to do the redemptions on those timeframes, we're liquid and can do it. But this is not something it's an illiquid investment. That's part of the reason that it pays so much more. It's not like a day trading thing where you can jump in and out and sell at a loss. This is not like that. And that day trading, I mean, I'm not telling you what to do, but boy, I've seen a lot of people lose money just jumping in and out. Frankly, they do better a lot of times if they just took a position and left it alone. You'll receive your interest to the bank account that you nominate. How do you invest? So simple. We'll get you a link and you can read over the information, fill in, what bank do you want to receive the money at, fill in your information. We do all the KYC thing, but we make it so easy. A lot of people, when they hear that KYC, they're like, oh no, not that. But we make it easy. We put it together where it meets the requirements for KYC, but we try to make the process as easy for you as possible because we want your business, folks. We want your business. So those are kind of the information on it. You are welcome to contact me. You can call me. You can email me, and love to speak with you. So that's it for our presentation today. I'm going to stop the recording and then I'm going to open it up to any questions. If there's any questions, I'll be happy to answer them. So thank you again for joining us for this presentation today for Alamo Mortgage Holdings.